Welcome back. As promised to talk about macros, micros, Maneesh Dangi, CEO and founder of Mosaic Asset Management is with us on the show. Thank you very much, Maneesh, for joining in, and Happy New Year to you. You were cautioning that 2024 may be a muted year for equity markets, and in a way it's played out for large caps, with the large cap indices giving a return of less than about 9%, 8.5%, 9%. What's the prediction now for 2025?
Morning, Nima. I guess the view for 2025 also is that the risk premiums will be inverted. I think bonds will end up doing better than equities even 2025. I think it's no more speculative that Indian growth is slowing. All markers, both in consumers as well as otherwise, they suggest that Indian growth has slowed pretty significantly. And these bouts of slowdown tend to persist for longer. So my guess is that for 2025 also, we'll have lowish return in equities and bonds will still deliver most probably 9-10% or perhaps even higher. So therefore, at margin, investors should still be overweight bonds and they will likely deliver better than equities over 2025.
And you believe that the growth will remain slow in the first half of the year? In H2, things should pick up. What would be the prediction? And do you think an RBI rate cut or something in the budget can spur investment, spur the consumption cycle back and push up growth?
Yeah, towards the end of 2025, it should start to gain traction. Rate easing, regulatory easing, all of them take an effect, but they take effect with long legs. So maybe 9-12 months out, you should start to see some acceleration. But the past actions of regulatory tightening, high real rates in India, of course, what has happened to USD INR, all of that will continue to impact growth in near term. So you will see some signs of green shoots in 8-9 months' time, but sort of pretty much whole of year would be the narrative would continue to paint a picture of slowing economy instead of accelerating one.
Manish, we get your point. So as far as 2025 is concerned, you believe bonds will most likely go ahead and once again outperform equities. Now, within the equity space, which are the pockets or which are the segments that you like? FY25 has largely been a year where earnings has been quite muted. So going ahead, where do you think there could be a quicker recovery?
I sort of, so let's say if you were to think of equity as capex versus consumption, my sense is that capex is overpriced in India, and so at least the local capex plays, won't do well. Global capex plays like IT, perhaps would do better. It's a better defensive play. Within consumption, of course, the discretionary consumptions would do worse than non-discretionary ones. Staple growth, especially the rural side of economy, would begin to pick up at some point. Albeit it's a smaller part of the economy, but would do rather well. So that part of the economy perhaps would do better. Within financiers, most probably the ones which actually are non-retail in nature would perhaps do better. We are entering most likely in a cyclical downturn in terms of, retail assets. So NBFCs and banks which are hyper-focused on retail only would, see delinquencies rise over the next 6 to 12 months' time and, would perhaps do worse. So in some sense, nothing in absolute terms will do gangbusters, but as a portfolio managers, if you were to sort of create defenses in your portfolios, that's how you'll have to place your bets in the portfolio.
How worried should we be about retail delinquencies?
I think it's fair to say that India is first time ever seeing a nationwide distress in retail. Very, very mild so far, but first time nonetheless. And this is happening without any external intervention, demon, COVID, GFC, all of that is not present. Just because I think the overall indebtedness of households have risen, the income slowdown is resulting in actually delinquencies rise. So in some sense, it's first of kind. And to that extent, if you as a market participants are betting on very sort of rapid growth in retail lending, I think that bit, you should be worried of. Would that be anything close to what we've seen in industrial delinquencies? Answer is no. But you would still see across retail side, including housing most probably, a rise in 1 to 2% NPAs in this year. So the whole of year, there'll be a change in the narrative that Indian retail is such a sort of a solid place, which never gives losses to sort of bankers and financiers. I think that change will happen. You will begin to see a cyclical downturn in the household portfolios of bankers and financiers.
But right now it's an unsecured. But do you think as the cycle extends itself, the stress will extend to the unsecured, to the secured portion of retail loans?
Rima, basically, again, the general chat in the town, of course, if you talk to NBFCs, is that, you're starting to see some stress in, even in the secured ones, so the small labs, gold loans, you sort of starting to see stress in sort of affordable housing related plays. So the stress is no more just in unsecured. Of course, unsecured stress has been sort of well known. MFI and credit card stress has been sort of well known for last 6-8 months. I think it sort of is entering in secure space also, not in the prime segment, but so-called subprime part of the collateralized lending also is starting to see some stress. I think the big picture still is what is more important is that it is no more this easy a sort of a call to take that Indian household credit will continue to secularly rise without giving delinquencies. It's the first time, as we are saying, that we're seeing some stress. It sort of does happen that, of course, it always begins in unsecured and enters into secured globally. I think something similar will happen in India also in next 6 to 12 months.
About U.S. markets, 2024 stood out for U.S. exceptionalism. That became the catchphrase. And equities, everything did well. So what's the call on the mother market? Because it all flows down from there.
Yeah. So it is, for us, actually, the most important thing is U.S. economy must slow. Only then you will get breathing space of actually easing rates and, currency will stop depreciating in a meaningful fashion. I guess it is anyone's call. I kind of thought that by now US should have slowed considerably, but it continues to surprise. In fact, India and US were the only exceptions, until about 8-9 months ago. But India too has fallen off, and US remains the only strong play. There are sort of chinks all over the place in US, but it's anyone's guess whether US would sort of slow rapidly or would still sort of continue to have a very, very slow descent, so to say. Unless, of course, US rates cool off, all bets are off on all assets outside of US. So to that extent, if you are a derivative of US trade, you ought to pray for US slowdown and thereby sort of lowering of US rates significantly from where it is right now.
Manish, one question, you've pointed to the retail delinquencies and we're seeing it for the first time. You said that, one way of easing this particular pain could be a rate cut. So how do you see that particular cycle pan out and how constrained are we fiscally to go ahead with these rate cuts?
No, fiscal actually, I don't think that's the play here. I think regulatory easing with respect to NBFCs and unsecured finance should come, with the change of guard. There's a little bit of a change that you hear in RBI's view now, in the manner that they're now sort of approaching a lot of restrictions they were putting on some of these NBFCs. So I think, that change is already underway. This soft communication to bankers not to lend to aggressively to the small NBFCs and, to go slow on the unsecured finance. I think there's a little bit of a pullback in terms of communication. You won't hear very strongly from RBI about this, but that change is underway. So I guess that part I'm more convinced that regulatory restrictions or obstructions will actually will unwind. On the monetary policy side, I guess it's more linked with retail stress. And I'm fairly certain that, India will have more rate cuts than what markets are baking in right now. Feb rate cut, I think Lata was pointing out, how a consensus also approaches Feb with sort of one rate cut to begin with. My sense is that India should see, 75 to 100 basis point rate cut over next 12 months. So that should sort of alleviate some pain with respect to all these stress that you're seeing in the retail side.
Thank you so much, Maneesh. We wish you a very, very happy 2025. Thank you so much for joining us and giving us your view as far as the outlook is concerned.